Good evening, ladies and gentlemen, and honored guests. It's wonderful to join you all tonight. Thank you very much for your time. We're extremely appreciative. For those of you who don't know me, my name is Tina Powell. I'm Director of Business Management for Beacon Wealth Management. I also happen to be a proud graduate of Fairleigh Dickinson University and a volunteer mentor here at the Silberman College of Business. We were honored to have Dean William Moore join us for a short time, and we are also, too, honored to have many FDU alumni, students, and faculty here in the audience. So thank you. It really is a pleasure. We have an incredible evening planned for you this evening. I would just like to take a few minutes just to thank the people who make this possible, because it is indeed a stellar event that involves the effort of a lot of people. First of all, FDU, I want to thank you for all the help and for allowing us to have use of this beautiful auditorium. I'd also like to thank our sponsors, TD Ameritrade, Putnam Investments, iShares, and Mainstay, again, who make tonight's program possible. I present to you an incredible panel of speakers who are just going to delight you this evening. We've got Andy McGorman from Wallach Beth Capital, Caroline Edwards from Putnam Investments, who works alongside David Glancy, and our own Mark Germain, CEO of Beacon Wealth Management. And hiding here in front of the room is Patrick Williams, publisher of Worth Magazine and VP of Sandow Media, who also is serving as tonight's moderator. I would also like to thank the various team members I'm privileged to work with each day. We're all wearing a silver name tag. If there's anything that we can do to facilitate tonight's evening enjoyment, let us know. We're here to help you. So our first speaker, Mark Germain, needs no introduction. However, let me just tell you a little bit about him for those of you who don't know. He spent the last 30 years in the industry. He's one of the best people that I know and one of the best professionals in this industry that you're ever going to meet. He has an MBA in finance from Northeastern University. He's got a Bachelor's of Science in Economics from Southern Connecticut State University, where he was recently honored and given a prestigious award just a few months back. Started out at Deloitte and Touche as a municipal bond specialist. Then went on to become a CFO, CIO of a technology firm, and then transitioned into wealth management. He's got more series licenses that I can remember, but you can talk to him and he'll rattle off all the numbers. He's a certified financial planner, and we are too also honored to have a few of his class. They were with you last evening, so they're coming back for more tonight. So again, perhaps the best way that I can introduce Mark to you is here by the following, if you just give me a minute. And this, again, I want to say that was made possible to Patrick Williams and Worth Magazine. And again, it speaks for itself. It's a little show called Fox Business News, in case you know it.
We bring you investment tips and advice from some of America's featured in Worth Magazine. And with us now, Mark Germain, CEO of Beacon Wealth Management. Mark, welcome to the show. Everyone's doing really well right now. Do you feel that there's a lot of pressure, more pressure on you as a professional money manager when the market's going up like this? Are people unrealistic about the returns, and how do you react to it?
Well, that's a great question. Thanks for having me in, because I love talking about this. Clients always want to be in the market when it's doing great. Right. They never want to be in the market when it's going down, and they can't understand how you could possibly have anything in the market when it's going down. So yes, there is a tendency to have unrealistic expectations. What we do with all clients is try to set the bar as to what is realistic going forward.
Well, what is realistic then? On that note, what is realistic? And by the way, I have people who will stop me on the street and say, Charlie, I made a lot of money on this particular stock. And it might be a stock that went from $1 to $3. And I say, that's great, fantastic, but did you ever consider the risk? Now, when you're dealing with people with at least $1 million, that must play a bigger role with respect to how they want to approach this market.
I think it's important is that you hit on something that is critical with people, is that they don't recognize what the risk and the volatility of one investment versus another is. So explaining to them that the market has a risk level of 1. This security has a risk level of 2. It means it's twice as risky as the market. Are you willing to take that?
That's enough of me. You're going to have a little bit more. But what a great time to really get in and talk, because we started talking about risk and we were going to get on to volatility. But I want to thank everyone for showing up. All of my students knew they can't pass the course if they don't show up tonight. So, other than Dave Flamholtz, who had to go to Israel, we can excuse him for this. Anyway, we've got a great turnout. We have people as far as L.A., right? We have L.A., North Carolina. I know we have one of the development office. What's that? Fort Lee. We have them from everywhere. So we have quite a cast, and we really appreciate you being here. As Tina introduced people, we're going to talk tonight. But before I do, everyone knows what volatility is, right? That's when you don't get your way. Okay. Yes, we're going to talk about volatility. But before I do, we have to do what the lawyers tell us and make sure that this is not advice. This is just education. And that's all that we're doing tonight, is providing an education. There's going to be 3 of us speaking, and then there will be a big Q&A afterwards. We're going to be up here. You'll be able to ask us any question that you like. And my students, Des in particular, has been warned, don't ask anything about slope in a line and figuring out all the numbers. I don't want to be doing all of that. Anyway, we're going to get to harnessing volatility, which is really what tonight is about. And the first thing that we really need to do is talk about what volatility is. And it's not just getting your own way. It's really what is going on is the rate of price change in securities or in a market. A security with a high volatility is going to have more fluctuations in price than a security that has low volatility. So we like to use, it's kind of this whipsaw thing that everybody thinks about. And we take a look, and we're going to show you August of 2011, the most volatile period since 1932. I was very young in 1932. I got ahead of you on that. Okay? So the more quickly a price changes up and down, the more volatile it is. As such, volatility, we just got off of risk, is used as a measure of risk. How risky are my investments? How risky is my portfolio? How volatile is my return? It went up, it went down. So as we look at volatility, a stock whose price changes 10% one day, 25% the next day is much more volatile than something that's going up or down 2%. Everyone would agree with that. Volatility is usually observed looking backwards, kind of looking in the rearview mirror. One of the key things that we think is you can look at volatility going forward and get an idea of where you should be from what is going to happen in the future. And volatility, the VIX, which we're going to talk about right now, can be observed by looking at what are option contracts doing. That's what the VIX really is. This is a chart of the VIX, which is volatility. This is a standard that was created by the Chicago Board of Exchange in 1993. We didn't start being able to actually trade in volatility until 2004. However, if we take a look, and it does, that's great. If we take a look at the beginning of 2011 and go straight through, take a look at this. This is what happened to the volatility of the market in a very short period of time. This they call the fear index. Volatility, or the VIX, is the fear index, kind of what Florence was just talking about, okay? How do we define it? Like I said, it wasn't developed till 1993. It wasn't traded till 2004. It measures the market's expectation of stock stock market volatility over the next 30 days. How do they calculate that? It's calculated based on the movements in the put and call options out there on the market. A put option, in case you don't remember, put option gives me the right to put something to you like a stock, and you must pay me the price that we agreed on. A call option is going to allow me to call your stock away from you at a particular price. So we quote volatility as a percentage. So 15 says that the market is going to change 15% up or down in the next 30 days. Well, how many trading days is that? It's only 21 trading days. So we're dealing with a statistic that really only looks at the next 21 trading days in the market. And one of the things that people are always asking is, if I believe that volatility is going to go up, can I trade it? If I think that volatility is going to go down, can I trade it? It's not for the faint of heart, although it can be done. So this gives you an idea of what volatility looks like, and it gives you the scary part, that everything can go up and it can crash as quickly. The inverse of volatility in the last Monday, down 10%. Volatility, so we were in the inverse of volatility, and in 3 days last week it went up 20%. And on Monday it went down 10%. So volatility is something not for the faint of heart, and it's not a long-term investment. It's a short-term investment.